much for joining me today. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And I'm so excited to talk to you guys today about the tax advantages of real estate. Now, I'm not going to make this the normal, webinar that you've probably seen about opportunity zones, 1031, stuff like that. I wanted to kind of drive down and make this more tangible for passive investors, active investors, and whether you've actually never invested in real estate before, you guys break out the notepads, break out the pen, because you are going to be able to apply a lot of the things here, whether you've never invested in real estate before. But before we get started, I always want to direct you guys, if you've got a question, go to your chat box or the Q&A box, type them in. Q&A box is a little easier for me to track, doesn't matter. But make sure to type your questions in. I will do my best to answer the questions in line with the presentation. If not, I'm going to stop a little bit early so we can clean this up at the end. But you guys ready to get started? Let's hit it. So if you guys don't know me, again, my name is Whitney. I'm the Director of Investor Education here at PassiveInvesting.com. But just a quick little note, I've been in real estate since 2002. I started off living, flipping, and house hacking. And yes, this is me and my crazy crew. They're the reason why I got into real estate, and really, I should say, really started scaling my portfolio. I did a few live-in flips and house hacks on my own, and then met my husband, and we did a few more together. But what we couldn't really quite figure out was how to unlock our golden handcuffs and our passive, earn true passive income. And it finally, we had to slap ourselves in the head. We were like, oh, instead of flipping the house, we need to hold on to it and actually rent out the properties and collect passive income that way. And we scaled about 30 units in Kansas City, Indianapolis. We're still doing some fix and flipping on the side to replenish our capital. And then we had a little baby, and I was also taking care of family members at the same time. Anyways, the wheels kind of came off. I needed to figure out a way how to transition my active strategy into a more passive strategy. And that's really when we kind of blew the doors off of scaling our portfolios, when we moved into multifamily passive investing. Now, the reason why I'm telling you this is because I can actually speak both to the active side and the passive side. So I'm hoping that I can provide an immense amount of value here today. But just to kind of give you an insight of where our portfolio stands, we have over 6,300 multifamily units. I should really say residential units in our portfolio. We still have long-term rentals, short-term rentals, residential assisted living, as well as our multifamily. We got some mobile home parks too. And we have over 1,400 self-storage units. But what real estate has afforded myself and my family is this, and this is really the true reason why most people get into real estate, is we have 100% control of how we spend our time, freedom of choice, and that is so important. And if you're not familiar with us here at PassiveInvesting.com, we've scaled a nice size portfolio as well, and we can actually help you achieve the same results. And I will show you here at the end how you can connect with me directly. But you guys are here to learn about the tax advantages of being an active and/or passive investor in real estate. And as I promised you, I'm going to share with you some tidbits on whether you've ever, even if you've never invested in real estate, how you should be looking at your tax structure. Okay, but I have to put up a disclaimer. Anything I share with you today is not financial advice, it's not legal advice, it's not tax advice. Take it back, take lots of notes and take it back to your team. I'm not a CPA, but after almost 20 years in this business, hopefully I have a lot to share with you. Okay, so let's kind of set the scene here, right? I hate starting off with saying people are generally doing their taxes wrong. But if you just think about it, most people are. We are actually, as Americans, okay, and I would say in a lot of European countries, Australia, stuff like that, we're actually trained and raised to pay taxes, okay? Especially if you're kind of coming up in a traditional education environment. Because let's think about it. I know for me, I was told, get a good education, get a great high paying job, save for a house, go buy that house, get married, have kids, okay? Which means I take my standard deduction on my taxes, okay, because that's the easy button to push. And if I got enough left over, save for retirement, okay? Then invest. All right. Now, if you think about this, this is the exact formula to paying high taxes. Okay. Let's flip this formula on its head. All right. Because if you think about it, the IRS actually can be our partner. Okay. If you think about it, the tax code is like a treasure map. Okay. It actually tells us where investors should be investing their monies, okay, in order to get tax breaks. All right. And the IRS wants investors investing their monies to solve problems. And what are the biggest problems that the US has that the government just wouldn't be that good at solving? It's going to be housing, real estate, starting big businesses, okay, maybe oil and gas, energy sector, right? Those are the things that the government is just very inefficient at doing. So they incentivize investors. All right. So we have to actually, instead of like going back to this scenario where we think, oh, taxes are just part of life, we need to think of the tax code as a treasure map for us to figure out where we're actually being incentivized to invest. Okay. Naturally, I love real estate. I've been in real estate for 20 years. This is like something I'm super passionate about. I love solving the problem of housing. I come from a public health background. If you guys know me, my background, that I went to med school for a couple of years, got into public health, was a public servant, but I really loved housing. I mean, it's the basis of Maslow's hierarchy needs. Everybody needs a roof over their head. Okay, now there's all different forms of real estate, but when we go through today's presentation, I want you to understand the overarching tax benefits of real estate, tax advantages, is that you can actually reduce income, okay? Maybe not your personal W-2 income, but other incomes that you bring in through taking strategic deductions. You can convert the income on how it's earned according to the IRS by maybe utilizing a more buy and hold passive type investing strategy. You can shift your income and how it's earned utilizing entities. Sole proprietorship, you get, a little bit of benefit. LLCs, corporations. You can eliminate income through credits. You can also then defer income through QRPs, qualified retirement plans, self-directed IRAs, solo 401ks, etc. Now, if you guys only take a snapshot of one slide in this entire presentation, it's this one, okay? Because this is the exact formula. Let's just say you knock real estate off of all of this, okay? We're not even talking about real estate anymore. It all boils down to how can you take deductions to reduce your income, convert how you earn your income, shift your income using entities, eliminate through credits, and defer through qualified retirement plans in that order. So let's dive in a little bit further. So why is this even important? Okay, because when we talk about the tax advantages of real estate, deductions, entities, credits, deferrals, okay, that can shelter income. But what the IRS give us, okay, what they partner with us on, they also will take it away if we choose to no longer stay in partnership with them in real estate. So say you decide to sell an asset or move title on an asset, it could trigger some recapture of some of these benefits that you've already taken advantage of. Okay, so that's why it's really important for you to understand, okay, what are my advantages and how could they be recaptured from me? So let's start with our first tier. Number one, what should we all be looking to do as an active or passive real estate investor is maximizing as much as possible strategic deductions. Now I say strategic because you don't want to just like put any deduction against your income. We're in it to make money, but how can we shift a lot of our expenses to be a qualified business deduction? Okay, now think about it. For those people who never invest in business, never invest in real estate, the only deduction they'll ever be able to take is their standard deduction. Okay, with the 2017 Tax Cuts and Jobs Act, that standard deduction is now higher. Okay, but that would be the only one that you'd ever be able to take. Having a business like real estate will allow you to take more deductions legally before you have to start paying taxes on earned income. Okay, so when we're looking at deductions in real estate, we can actually use losses, okay, these deductions that create losses for us to offset income. All right. Now, if we're active in real estate, say we're fix and flipping or a general partner, all right, we're not going to be able to utilize a couple of these deductions that I mentioned here today. But across the board, we should be able to benefit largely from deductions. Okay. Depreciation, that's one thing in real estate that is amazing, right? If you're in multifamily real estate, your depreciation schedule is 27.5 years. Okay, we can actually do what we call a cost segregation analysis, where we send an engineer into the property. They break up all the different parts of the property, and anything that can be broken down in 20 years or less on that depreciation schedule, we can actually, according to the tax law right now, take bonus depreciation, accelerated depreciation, push it to the early years of the project, okay? Usually in under 5 years or under, okay? That was part of the Tax Cuts and Jobs Act of 2017, okay? Where companies can actually not only take the accelerated depreciation, but also take 100% bonus depreciation. Okay, now bonus depreciation is set to expire in 2024, okay? However, right now it's set to just go back to 50% rather than 100%, and that's where it was before 2017. Another thing that we can take a look at, that's really kind of cool with deductions, especially the depreciation deduction, is if you in real estate as an active investor can qualify for real estate, what we call real estate professional status. Now, guys, I know this is going to be a huge rabbit hole. I'm going to save this rabbit hole for at the end of the presentation to dive down, but that's another way you can maybe unlock some of these deductions against your income. Now, what do the deductions look like? What are some common tax deductible, expenses? And here you go. Here's a general list of them. Okay, and as you see here right now, depreciation. These are your big expenses: interest, depreciation, taxes, and insurance. And then you start getting into the rest of them. All right, depreciation is a big one for us. However, it is also one that we're going to talk about later on that can be recaptured. Okay, but that's a huge benefit to us as real estate investors. Okay, so that was step number one. How can we maximize our deduction? Step number two, how can we convert our income? Real estate is amazing for us, both actively and passively, to allow us to shift our income to other parts of the cash flow quadrant. Now, if you guys aren't familiar with the cash flow quadrant, this is one of my favorite books by Robert Kiyosaki. Okay, most of us have heard of Rich Dad, Poor Dad. The cash flow quadrant is actually the second book after Rich Dad, Poor Dad. Now, he does go over the cash flow quadrant a little bit in Rich Dad, Poor Dad, but he really dives deep on how to maximize it in the second book. Okay, so if you're not investing in real estate already, most people will earn their income actively as an employee. Okay, maybe as self-employed, maybe they're you have your own practice or something like that. But these two categories are going to pay the most in taxes. All right, now pop quiz, guys. I want you guys to go over to the chat box. Who pays the most in taxes? The employee or the self-employed? Okay, take 10 seconds to jump in there and type in what your answer is. Okay, we got some employee. Okay. All right, Kathy is after my own heart. It's the self-employed. Why is that? It's because they actually have to pay their payroll taxes. So they have to pay additional taxes on top of what the employee pays. All right, so both sides, both pay really high in taxes. Absolutely, both categories pay high in taxes. So it's really important to figure out, how can we shift our income from employee, self-employed to the other side of the cash flow quadrant, to be in the business category or the investor category. Now, converting income is really as simple as that. How can you convert your income from an active, earning it actively, into earning it passively? Okay. So most active investing, okay, if you're fix and flipping and stuff like that, you're actually going to be paying largely into the self-employed category. Now we are going to talk about, how you can, get it over into the, like the business category and the I category and stuff like that. Passive investing, if you were just going to go in on a syndication or a fund, you're taking your whatever income you're earning as an employee or self-employment, and you're jumping right over into the investor category. Okay. The B and the I categories are actually going to have the most tax benefits. Why? Because they can take advantage of deductions. They can take advantage of the entities and stuff like that. And we're going to see that here. Okay. All right. Now, guys, remember, I have like some comments coming in. Remember, I'm not a CPA. I'm not going to go into like the intricacies of every individual situations. This is large education. Take this back, okay, this primer back to your own CPA and figure out how it applies to you in your particular situation. Because if you're partnered with an accountant right now that says the number one way you can reduce your taxes, okay, for 2022, we're not going to talk about 2021, that ship's already sailed, is to actually, contribute to your IRA. There are a few other steps that you can actually do before then. Okay. How can you maximize those steps? Right. So step number 3 is how can you actually shift income to other tax brackets? Okay. Now I love real estate because this fits into this step pretty readily right here. Is because, if you don't have a business like real estate, if you're not investing actively or passively, you're probably only going to be your only capacity to shift tax brackets is going to be how you treat your capital gains. Maybe you have stocks, bonds, and mutual funds, and you are, if you hold them less than a year, you're going to pay short-term capital gains. Your only ability to convert that income or shift that income is going to be or shift that capital gains to hold it more than a year. Okay. Same thing applies with real estate. Like if you're flipping real estate, if your intent is to hold the property a year or longer, you're going to be more in the long-term capital gain category. And if you sell it in under a year, or if your intention is actually to flip the property, you're going to be paying short-term capital gains. Now, if you have a business like real estate, you're actually going to have some other opportunities to shift income as well. Maybe you can bring in dependents to work in the business. Maybe it's your kids, or maybe you have your 1 or 2 of your parents are retired. They maybe aren't maximizing their standard deduction. How can you employ them and shift monies that you're earning to their tax bracket? Also, you can look at utilizing entities to reduce your tax bill. Okay. So for my CPAs that are actually on here, there's qualified business income. Okay. There's a whole provision around that. All right. You can talk to your accountant to see like, okay, can we organize my business, real estate business, in such a way as that I can maximize the qualified business income pass through? Does it benefit me to open up and pass through an LLC rather than my personal name for tax purposes? Can I take advantage of corporations like an S Corp or something like that, so I can actually pay myself a W-2 wage and then take the rest of my earnings as a distribution through the corporation? Okay, so there, definitely talk to your CPA on what are some strategies. The question here would be, what are some strategies I could use to shift my income to other tax brackets, okay, in order to lower my tax impact? And again, real estate really can help us with this. All right. Step number 4, eliminate income. All right. So this one, I've got some like little stars here, and I'm going to explain that here in a second. So ways that you can actually eliminate income, where you could just get kind of like a tax write-off right off the top of the bat, dollar for dollar credit, is maybe you can contribute to an flexible spending plan. Now, this is not particular to real estate professionals. Okay, those are actively or passively involved in real estate. This is just general advice. Can you utilize a flex spending account? Okay, that eliminates, as long as you utilize it for health purposes, that eliminates the tax on that income. Maybe you have kids. Can you utilize a flexible spending, what we call dependent care account, to offset some childcare costs? And again, you just get, a permanent tax reduction right off the top. HSA accounts, health savings accounts. All right. How can you utilize that to eliminate, part of your income and reduce your taxes? Roth, right? If you think about it, you're already going to pay the tax on the Roth now, but when you invest within a Roth IRA vehicle, it can grow tax-free, come out tax-free. Okay, you're eliminating the tax on that income. Whole life insurance is another way as well. Okay, maybe you're paying the taxes right now, but that you can fund a whole life policy and it can grow tax-free, compounding tax-free, and then you can take loans against it and maybe utilize the income, when you start unwinding the policy or taking loans to live off of in the future, that money comes to you tax-free. Other things that you can do are look at actual credits, okay? This can be personally, it also can be within your real estate portfolio. Us as real estate investors, actively and passively, we can get credits if we provide or put energy efficient products on our properties, maybe solar panels on the roof, energy efficient appliances on the property. We can also, get water credits, especially on, large scale multifamily. We can do low flow toilets in all the units, low flow shower heads, put in some other water saving amenities on the property. We can get dollar for dollar credit on that. Another strategy that I love is on multifamily in other projects is, is there a way to take advantage of a tax abatement? All right. On one particular property I'm invested in, it's lower income housing, and they set aside a portion of the multifamily unit to go to more affordable housing, and the city gives the operator a tax abatement. Okay. I'm doing a service, I'm solving a problem in the community as the investor, and I'm getting rewarded for it with a credit. And then there's other credits out there for research and development, employment, non-real estate related credits like oil and gas and stuff like that. Now, like I said, there are like little stars here. These vehicles listed up here above can also potentially avoid provisional income at retirement. Okay. And you can also utilize them to invest in real estate. Guys, there is a possibility that you can set up a self-directed HSA account, much like you do a self-directed IRA account. Okay, and invest in other alternative assets. Okay, and that does exist out there. Okay, and then we get to the end, the last step. Okay, how can we defer income? Okay, now as real estate, actively and passively, this is also another really powerful strategy. Is how can we tap into self-directed IRAs and qualify other types of qualified retirement plans like solo 401ks, QRPs, stuff like that, to actually we can, fund these plans, and we can go invest in real estate and maximize, the tax deferral on these things. We can do lending, we can do fix and flipping, we can buy and hold, we can partner with other, with other IRAs. We can also partner in syndications and funds. All right, so that's another opportunity for us as well. All right, now this is what we talked about, all the different tax advantages. What can you do with real estate? Okay, there are a lot of cool things that we can do in real estate that help us maximize that 5-point plan that we want to work our way through to help lower our tax bill. But at the end of the day, what happens? The ultimate question, okay, we all have a building that we think that we're going to want to sell. What happens when we want to exit an asset? All right, what happens then? And again, like I said, there's a lot of things the IRS partners with us on, but what happens when we want to exit? What happens to that partnership? What does the IRS want back? Well, first of all, if you want to sell, you could simply do nothing. Okay, just cold turkey break the partnership with the IRS and pay the capital gains. Okay, I would only want to do this if you want to completely exit out of real estate. And even then, I would challenge that. I just got off a webinar where we talked about deferred sales trust. So there's so many different ways that you can actually permanently continue, or not permanently, I shouldn't say permanently, continue to defer your capital gains if you wanted to sell an asset. All right. Number two, maybe you want to sell an asset, an asset that you're going to make a gain off of in the same year that you sell an asset that you're taking a loss of. Okay. Maybe you compare that with what I say, selling your dead properties, and do tax loss harvesting, where you're actually harvesting your losses, okay, in order to offset that gain. You can do a 1031 exchange, right? 1031 exchange is, for those of you who don't know, that's the part of the tax code where the IRS will continue to partner with us and defer our taxes and defer our depreciation recapture as long as the active or passive investor continues to invest in real estate. Now, as an active investor, you've got a whole timeline that you need to follow: 45 days to identify an asset, 180 to get invested in an asset. You're in charge of that timeline. If it's a passive investor, you actually have to stay within the LLC that is investing. So a good example is with passiveinvesting.com, I was partnered on an asset that ended last year. They let me know, hey, listen, we are going to sell the asset. And if you want to stay in the 1031 exchange with us, here's the next asset we're going to purchase. And so that just made that process really seamless for me. I didn't have to worry about the timeline as a passive investor. All right. Question: what is the deferred sales trust? Guys, look, if you're not already on our passiveinvesting.com list, jump over to passiveinvestingwithwhitney.com, join that list, because we will be sending out the replay of the deferred sales trust webinar today. Essentially, a deferred sales trust webinar deferred sales trust can actually take the place of a 1031 exchange. There's a lot of different bells and whistles. There are, it probably only makes sense if you have $1 million net gain on your property in order for you to go into that due to the cost. But you guys feel free to jump over there and we can share with you the webinar. All right, number 4, you have an asset that you want to exit, okay? You're just like, no thanks, I don't want to do a 1031 exchange. You can actually take the gain and then totally reinvest in another asset and reset your depreciation schedule and take a whole nother, book of depreciation. That's what I kind of like, we kind of term the lazy man 1031. So again, essentially it's a reinvestment strategy. And there's tons of other strategies out there. You can do an installment sale. That's really great for active investors, opportunity zones, deferred sales trust, charitable trust. So there's a lot of different ways, even if you are wanting to continue to stay in real estate, that you can actually continue to defer your gains in real estate. And those are all tools that are available to us. All right, so let's do a quick little recap, right? Everything that I mentioned here, for the most part, applies both to active and passive investing. It's just a matter of how can you partner with your accountant and CPA to put a plan in place that's going to work for you to maximize each one of these areas. Area number 1, how can you deduct? How can you take the maximum business deductions and take advantage of depreciation? Number 2, how can you convert your income? How can you change your active income into passive income? And guys, I'm not talking about the time involved for you to earn your income. I'm talking about how it's defined by the IRS, okay? That's very important that you understand that those two are different. Sometimes the word active income gets thrown around a lot. Our passive income gets thrown around a lot, but we need to couch that with the IRS definition of active income versus passive income. How can you shift income into different tax brackets, utilizing business entities, utilizing your other, maybe family members' standard deductions. Okay, that's another opportunity. How can you actually eliminate income? The tax on income through like 1031 exchanges, and really honestly that you're deferring it to a later time, or lazy 1031s. All right. And then deferring, how can you invest in self-directed accounts in order to maximize your real estate investing, both actively and passively? Okay. Now, the key here is all these things will work for you if you hold the asset for 1 year or longer. So my fix and flippers, not everything here will apply to you. Just make sure that you are partnering with your CPA to understand what does. All right, guys, I know we've got some questions coming in. I will stay on the line to help answer those, but I want to make sure that I get everybody off here in enough time so you can enjoy the rest of your afternoon. Thank you so much for spending your time with me, investing in yourself. If you want more information and more videos like this, I do a whole webinar series of Passive Investing Made Simple Masterclass. You can jump over here to Passive Investing with Whitney. And in that masterclass, we just show you, I dive deeper on the pros and cons of passive investing and help you avoid making costly mistakes. All right, until then, thank you guys. Here's my contact information again. And you guys have a fantastic day.